I always thought that Warren Buffett never predicts market crashes.
Warren Buffett today has more cash as a percent than he had before the 2007 financial crisis.
I was always taught that Buffett likes to hold stocks and never sell them.
Warren Buffett has now sold 2/3 of his Apple shares, which is his largest stock position, and sold 266 million shares of his second largest position.
He has done more selling than buying over the past 2 years.
Selling stocks and hoarding cash? Either Buffett is losing it in his old age, or he knows something that we don't. We've got a bunch of things to look at in order to see why he's doing what he's doing. Is he preparing for a crash? The first ingredient that we need to look at is the prices of stocks. If prices are high compared to the average, then they're more likely to revert downwards. One of the best ratios that we have to measure this is the S&P 500 PE ratio. S&P 500 is just 500 of the largest and most well-known stocks in the market, and the PE ratio is comparing prices to earnings, the price you pay to how much you get in return. If we look at the current S&P 500 PE ratio, it is 30.6. So prices are 30 times higher than the earnings of the stocks. What does that imply? Well, the average throughout history is 16 for this ratio. This means right now, prices are almost double what they have been throughout history. One thing is clear, we're in an expensive market, but there's more things that we need to look at. Warren Buffett famously said that this indicator is probably the best single measure of where valuations stand at any given moment. The Buffett indicator compares the total US stock market value to the gross domestic product of the country. Anything below 84% is considered significantly undervalued. Between 84 to 108% is moderately undervalued. 108 to 132% is fair valued. 132 to 156 is modestly overvalued. And anything above 156% is significantly overvalued. And right now, this indicator is 201%, meaning at today's prices, the market is not fairly valued, not modestly overvalued, but significantly overvalued. In 2007, before the great financial crisis, this indicator was only half of this at 105%. And even before the 2000 dot-com bubble, the indicator was lower at 138%. It starts to leave a clue why Buffett is doing what he's doing. Since 1981, the stock market has essentially been on a one-way ticket up. Yeah, we've had a few blips on the way, but the S&P 500 has gone from 346 points to 6,000 points. It does make you wonder why. And then you take a look at US interest rates. Since 1981, the interest rates have essentially been on a one-way ticket down, from 19% to 0% rates if we ignore the little increase we've had recently. This might remind you of a famous Warren Buffett teaching.
Everything in valuation gets back to interest rates. Interest rates govern everything.
You've looked at interest rates and said interest rates are gravity on stock prices.
He said interest rates are to asset prices what gravity is to the apple. When there are low interest rates, there is a very low gravitational pull on asset prices. And this is kind of what we've seen over the past 40 years. Lowering interest rates have allowed asset prices to increase because there's no gravitational pull on them. So they've just kept going up and up and up. The question becomes, well, what happens to stock prices when interest rates rise? This is relevant because, well, we've seen this rise in interest rates recently. If they continue to stay at similar amounts and don't drop too much, we might see a gravitational pull on stock prices. And that is another risk that's in the market right now, and a lot of it depends on what this man, Jerome Powell, decides to do. One of the most important recession risks is what I call the dreaded yield curve. The yield curve is historically one of the greatest predictors of a recession, and of course a recession is quite well correlated with a market crash. As you can see, the yield curve has accurately predicted the last 4 recessions, and actually even if you go back further, it's forecasted every recession since 1969. So it's a relatively reliable indicator, but what's it doing now? Right now, we have been in a pretty deep inversion. It went all the way down to minus 1.88, which is much more deep than it was in 07, 2000, and 89. You'd actually have to rewind all the way back to the energy crisis in 1980 to get a feel for a similar type of inversion this large. As you can see, we seem to be on the way out of the inversion, and what tends to occur when this happens? Well, a recession comes. Historically, the time between the first month of an inversion and the start of a recession has ranged from 6 to 18 months, as per S&P Global. Unemployment is quite a cyclical matter. It tends to gradually decrease over time and then have a sharp increase. Decrease over time and then a sharp increase. Right now, we've basically been on that gradual decline, except we have seen a bit of an increase as of late, which interpret that how you want. S&P Global use 9 leading indicators when trying to figure out if a recession may be on the horizon. As of the latest report, we have had 4 of those 9 signaling red, aka a negative growth level. Those 4 are term spread, consumer sentiment, manufacturing new orders, and bank lending practices.
S&P 500 Global wrote, notably, consumer sentiment moved back to negative after remaining positive since December last year, as consumers were wary about the 12 months ahead of business conditions, as interest rates continue to remain higher for longer.
With these unique market conditions, that begs the question, what should we do? Should we just short stocks?
Being short something where your loss is unlimited is quite different than being long something. You might think it's easier to make money on short selling, and all I can say is it hasn't been for me. I don't think it's been for Charlie.
Okay, so probably don't short, but here are some things that over the years Buffett has recommended to do. His general advice is don't wait for a crash before investing. I remember back in 2018, a lot of people were saying that the stock market is overvalued. Prices are at all-time highs. We haven't seen a crash for a long time. Be careful about where you invest. And guess what happened to stocks in the years following that? That's why, generally, you want to be very careful about playing the waiting game, because you can miss out on a lot of returns.
This company in 1890 or thereabouts, the whole company sold for $2,000. Got a market value now of about 50-odd billion. Somebody could have said to the fellow who was buying this in 1890, you're going to have a couple of great world wars, and you'll have the panic of 1907. All these things will happen. Wouldn't it be a better idea to wait? We can't afford that mistake.
The other thing that he teaches is generally you want to keep holding stocks, no matter what's happening with the market.
It's not our natural inclination to sell. And on the other hand, we have held the Washington Post stock since 1973. I've never sold a share of Berkshire, having bought the first shares in 1962. We've held Coke stock since 1988. We've held Gillette stock since 1989.
Holding stocks is very beneficial tax-wise, because you don't have to pay tax when you sell your stock if you never choose to sell your stock. Warren Buffett's made billions of dollars from Coca-Cola stock, and he's barely paid gains on that because he's predominantly only held the stock. As Charlie Munger says, the big money is not in the buying and the selling, but in the waiting. One of his major teachings has been you want to own pieces of businesses over time as opposed to cash.
Cash is going to become worth less over time, but good businesses are going to become worth more over time. The one thing I will tell you is that the worst investment you can have is cash. Everybody's talking about cash being king and all that sort of thing, but
cash is normally not king because it produces nothing. A stock, aka a business, produces food or sells products or develops technology and makes profit from this. Cash, yeah, you can get a yield on it from the government or in the bank, but businesses over time have done much better.
We always keep enough cash around so I feel very comfortable and don't worry about sleeping at night. But it's not because I like cash as an investment. Cash is a bad investment over time. But you always want to have enough so that nobody else can determine your future.
And advice number 4, he will often say, is just buy an index fund.
The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm, let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and it would come to $51 million now.
You want to know what's interesting right now? Buffett is not doing any of these. Instead of listening to what Buffett says, I want to dig into what he's doing because that's sometimes more important. The first thing that he's doing is
Warren Buffett, on behalf of Berkshire Hathaway, has been selling some stock, a lot of stock.
He is selling this stock, which has been his largest position since 2017. I never expected him to sell Apple. I thought he'd just hold the stock for life, which he'd done for a bunch of other major positions. But in the fourth quarter of 2023, he shocks us all. He sells 10,000 shares of Apple. In the next quarter, he sells 100,000, and then 400,000.
We have sold shares.
In total, he's now reduced his Apple position by 2/3 of the original amount. Why did he do this? The answer is actually obvious. He literally spelt it out to us in his latest Berkshire meeting.
We are paying a 21% federal rate on the gains we're taking in Apple. And that rate was 35% not that long ago, and it's been 52% in the past. They can change that percentage any year, and the percentage that they've decreed currently is 21%. And I would say with the present fiscal policies, I think that something has to give, and I think that higher taxes are quite likely.
He's taking money off the table while he has the chance to pay lower taxes. Smart move, can't blame him. What else is he doing?
Warren Buffett has been selling not only his largest stock position, but his second largest, too.
In the last few weeks, Warren Buffett's Berkshire Hathaway has been dumping billions of dollars worth of Bank of America stock.
In total, he sold about $10.5 billion worth of the stock, amounting to 26% of Berkshire's stake in the company.
After being a shareholder in banks for how many decades, he's now sold a huge slice of his largest bank stock, and the rest of his bank stocks, do you remember what he did with them?
Some of the banks that you've sold include USB, Wells Fargo, Goldman Sachs, JP Morgan, PNC.
I did sell banks that we'd owned for 25 or 30 years.
So that is a lot of selling. Fully selling all of your bank stocks apart from one, even that one you sold a big portion of, and then you sold most of your largest stock position, and then on top of this you've done more selling than you have done buying the last few years. This is very un-Buffett-like. So what does this leave him with? Have a guess.
Warren Buffett's Berkshire Hathaway now holds over $325 billion in cash after selling off billions in Apple and Bank of America.
They've now got more cash than ever.
$325 billion in cash. That's more cash than the entire GDP of New Zealand, Portugal, or Chile. But interestingly, it's not actually important how much cash Buffett has at Berkshire. 100 billion, 200 billion, 300 billion. What does that mean? It's all just big numbers. What's important is how much cash he owns as a percentage of his overall portfolio. Right now, he holds 50% cash compared to the amount he has in public US stock equities. The only time we saw something similar to this was a few years before the great financial crisis. In fact, he didn't even hold this much cash before the dot-com bubble in 2000. But just remember that this is compared to his US equities. If you compare it to his total portfolio, the cash position is more like 25%.
I don't mind at all, under current conditions, building the cash position. I think when I look at the alternative of what's available in the equity markets, we find it quite attractive.
So we've got Buffett saying all of the usual things, but at least as of right now, he's doing the opposite. So is a crash coming? Well, I personally have a view similar to Buffett, and that view is a view of agnosticism.
We haven't the faintest idea what the stock market is going to do when it opens on Monday. We never have had.
To predict what's going to happen next month or next year, I truly don't think anyone knows. But what we can say is that stock prices are fairly baked in right now. And there's also a few risk factors that are in there too. And who knows, maybe the right option right now is to play the game similar to Buffett, play it safe, and to take some cards off the table.